You ever look at the stock market and just see a blur of numbers, a waterfall of code, kind of like the Matrix? Well, that's not too far off. That's the world of quantitative or algorithmic trading. And today, we're going to plug in and see how it all works, and more importantly, how a single trader, maybe someone just like you, can actually compete.
So, just how deep does this rabbit hole go? Well, the first thing you have to get your head around is that algorithms aren't just a part of the market anymore. For a lot of it, they are the market. The bots are pretty much running the show.
I mean, check this out. Some estimates say that over 1/3 of all trading in the US is now completely driven by algorithms. Just think about that. That's a massive amount of buying and selling happening without a human ever clicking a button. It's a high-speed, high-tech battlefield out there. Which, leads us to the billion-dollar question. In a world of supercomputers and teams of PhDs, can a regular person with a good idea and a laptop actually stand a chance? I mean, is it even possible to go up against these institutional giants? Believe it or not, the answer seems to be a resounding yes. And our guide for this is Dr. Ernest Chan. Now, this guy isn't just some academic. He has lived this stuff. He's got a PhD in physics, worked inside the big machines like Morgan Stanley and Credit Suisse, and then he went out on his own and became a successful independent trader.
And here's where the story gets really good. Dr. Chan's own experience kind of flips the whole script. He says he was at these huge banks using unbelievably complex math, and he was losing money. It was only when he went solo and started using much simpler strategies that he finally hit his stride and became profitable. The lesson here? Maybe simpler is smarter.
Okay, so if simplicity is the secret sauce, how do you find a simple strategy that actually works? Well, according to Dr. Chan, it doesn't start with some secret formula you find online. Nope, it starts by looking in the mirror. You have to find a strategy that fits you.
He actually breaks it down into 4 really personal questions. First, what are your working hours, right? If you've got a day job, you need a strategy that doesn't need you watching the screen all day. Second, your programming skills. Are you a coding genius or is Excel more your speed? That's going to dictate how complex you can get. Third, your capital. How much money are you working with? That changes everything. And finally, what's your goal? Are you trying to build slow, steady wealth or generate monthly income? Each of these answers points to a different kind of strategy. It's a personal blueprint, not a one-size-fits-all thing.
All right, so let's say you've done the soul searching and you've got an idea that seems to fit your blueprint. You don't just jump in and start throwing money at it. No way. You have to prove it. You have to see if it would have worked in the past before you risk a single dime on the future. And this is the super critical step called backtesting.
So what exactly is backtesting? It's pretty much what it sounds like. You are testing your strategy on historical, or back, data. The best way to think about it is like a time machine for your ideas. You can literally take your strategy, rewind the clock 5 or 10 years, and watch how it would have played out, day by day. It is without a doubt one of the most important things you can do.
But, and this is a big but, this time machine can be tricky. It's really easy to get results that look amazing on paper, but would have totally failed in the real world. Dr. Chan points out a few major traps, like forgetting to include transaction costs, or something called data snooping, where you basically keep tweaking your model until it perfectly fits the past but has zero ability to predict the future. But probably the sneakiest, most dangerous trap of all is something called survivorship bias. You have got to understand this concept. Survivorship bias is all about the ghosts in your data. You know, the companies that went bankrupt or got bought out, the ones that just aren't around anymore. If your data ignores those failures, your results can look way, way too good to be true. Here's a simple way to look at it. On the left, you've got a biased database. It only shows you the winners, the stocks that survived. It's kind of like trying to figure out how successful a business school is by only talking to its billionaire graduates and completely ignoring everyone who dropped out. It's not the real story, right? To get the true picture, you need a complete database, like the one on the right. It includes everyone, the winners and the losers, the successes and the failures. That is the only way to know how your strategy would have actually held up in the real, messy world.
Okay, so we've seen the challenges. We've seen the need for a really disciplined process. But this brings us to what might be the most powerful idea of all. The reason an individual trader can succeed isn't in spite of being small. It's because of it. Being small is actually your superpower. Just think about it. The giant hedge funds, they have to manage billions of dollars. And because of that sheer size, they are forced to go hunting for massive trading opportunities. They have to find patterns that can absorb huge amounts of money. They're hunting for whales.
And that right there, that is where you have the edge. Your advantage isn't trying to outmuscle them. It's in hunting where they can't. It's finding all the smaller, profitable niches that they are structurally forced to ignore. A strategy that might only make a few $1 million is worthless to a billion-dollar fund, but for you, it could be a game changer. You're flying completely under their radar.
So it all leaves us with this really interesting paradox, doesn't it? In an industry that is completely obsessed with being bigger and faster and more complex, maybe the real secret for the little guy is to do the exact opposite, to stay nimble, be disciplined, and to think small. In the wild world of finance, could that be the smartest move of all?